no one had really heard of, or at least they know of, but they don't really talk about. So we'll get to that in the second half of today's recording. So stick around for the 7 ETFs that I think you should know about. You should definitely have on your watch list. We'll talk about all that in a sec. Now, I'm sure Hayden needs no introduction, but just in case someone hasn't heard Hayden's voice, Hayden is the co-founder of Perla and CTO, Chief Technology Officer, um, engineer by background, thrust into finance by passion, I'm assuming. Hayden, maybe just for everyone's benefit, just tell us what you do day to day at Perla.
Yeah, so I'm one of the, co-owners of Perla. I'm one of the co-runners of Perla. I tell people I look after technology, which typically encapsulates product, engineering, and customer service. So my job is to make sure that we're building the right product, that the product works correctly, and that our customers are able to interact with us both digitally and through any of our kind of help customer service arms of the business.
Cool. Cool. So you also teach computer science in this age of AI. You and I were talking recently. This is like a huge part of your life and what you are so passionate about. And it just so happens that finance and technology just happen to be colliding at an unprecedented rate, which is just amazing for everyone. And that's how, in part, the Perla platform has been born over the last few years. Now, that's all really fun and lighthearted and great fun. We're going to talk about different things today. I can see already comments here, over 500 people, probably most of them wanting to comment. You've built a tool for some things which we'll reveal in just a sec. But first, budget came out Tuesday night. High level, what did you think?
Good, good-ish, kind of neutral about it. I like the spirit of what they're trying to do. There's probably some like execution things that I don't love or I disagree with. Some of it I think is easy fixes. Some of it is just kind of like I get why they have to do that, but I wish they didn't. But yeah, I'm not a zealot either way or the other. I don't think that they've completely screwed anyone over, young people or old people. It seems like they're trying to do something and doing some okay things. And I hope that they nuance it in the legislation to get the I's and the T's right. Because I think that's really where it goes from like potentially good to potentially not so good.
Yeah, that's a really good point. So a lot of the things that were announced on Tuesday night are indeed proposals. So once, for those of you that don't know, what has to happen in a democracy like ours is that things are proposed and talked about, then it goes into writing or legislation, and then that gets debated as a draft in Parliament. If it succeeds, Senate will approve it, and then it becomes law, basically. And from that point, the ATO has to figure out how they do their bit. Accountants have to figure out how the ATO is going to do their bit. So then you can figure out how the accountant is going to help you understand what the ATO is going to do because what the government said. That's the simple version of it, but that could take a long time. For everyone's benefit, last year, I think it was late the year before, we had something called Division 296, which is probably the dumbest idea to finance and tax law ever proposed by a government in any country ever. And that was basically taxing unrealized gains. So that was where you would be taxed on money that you haven't earned yet. Like if your shares went up from today to tomorrow, you'd be taxed, which was the dumbest thing ever. And fortunately, even though they argued for that for many, many months and scared a lot of retirees, that's for sure, that was watered down and wound back and ceased to go into existence. So a lot can happen between now and whenever these things are supposed to come into effect. I am slightly on the negative side, if I'm being honest, Hayden, and I can talk about that in a bit. But can you maybe bring some of that balance, some of that engineering brain as well, some of the facts? What were you going to show us? I haven't seen this thing, by the way, that you have put together.
Oh, sure. Yeah, I mean, I can quickly bring that up.
Yeah,
Just
definitely. That'd be great.
if you could accept that request.
Okay, I think that should be in just a sec.
Yep. Okay.
There
Hopefully
we
that
go.
works all right. Um, so I'm just going to make sure this is up. This is something that I just whipped up really quickly on Tuesday night. You can get it. It's budget-2026.perla.com. There's a lot of big disclaimers there, so that, we don't do anything silly. But I'll leave this up on the screen for a second all I really wanted to build was something that helped people have a tactile understanding of the impact of this budget, right? It doesn't help people predict their circumstances. It's more like it basically says, let's imagine that the new proposals have been applied like forever in the past, you know? And then let's say, you went and got a bunch of capital, however many years ago, you held that capital at a certain growth rate, and then you sold it right now based on a taxable income that you have. What's the impact for you? So we can kind of see here that, if you invested $100,000 10 years ago, under the, new rules, and it grew at 7% per annum. Doesn't matter whether it's property or shares because, the CGT rules apply to everything. And then you sold all of that, to be worth 200 grand now. It's $100,000 of capital gain, and your current income's 90,000. If your current
Mhm.
income's 90,000 under the old rules, 30% marginal tax, 15% with the CGT discount, or 30% on half of that, whichever way you want to think about it. 14K under the new rules, they would, apply the indexation, which in this case is some number of percent, then you would have 20K to pay in tax. You basically pay an extra 5 or 6K in tax for that $100,000 asset if these new rules had been applied forever based on actual CPI data. So it's not a forward-looking one. It's about trying to just get a feel for it. And this also helps kind of people understand things like, for instance, if you have a 90K income when you sell this stuff, the 30% floor that's existing in the CGT change doesn't affect it. It only affects people who have no income. So if I was to change this, for instance, to say, let's imagine that you had no income the year you sold this, the difference is actually now quite significant because that capital gains as it falls into your income buckets doesn't have the tax-free one and the 14 or 16% one either. So it's kind of we're trying to help people understand too, like if you're going to sell stuff when you're earning money, that part of the CGT change doesn't matter. It also helps show you, you know what? If your asset only grew at 4% per annum, guess what? You'd actually have more money. You would have paid less tax, because if your investments aren't exceeding 2x inflation, um, like 2x inflation means it's the equivalent of the CGT discount, obviously. So it does help just kind of get a feel for it. And that's the point of it. Some people have asked, like, I want to put in all my transactions, and it's like that's not the point. The point is just, I see the levers this pulls and maybe how I should think about it in the future.
Can you just go back to the 7% growth rate for me, Hayden? Is that
Yes.
cool?
Yeah, easy.
So you said two things there, and this is probably where a big part of my issues come from.
Yeah.
So one thing that you can see on this page is that in effect for this fictitious person in backward testing, the difference between 14,000, which was the old CGT rate, and the new one is $5,000. Doesn't
Yep.
seem like a lot, but in percentage terms, you're paying 30% more tax. That's the first thing. The second
Yep.
thing is you said it doesn't really affect people that might be on 90,000 because they would be paying tax at that rate anyway, right? Their marginal tax rate would be,
The 30% floor. Yeah, that
yeah,
part.
yeah. But what that also means is if you have a lower income, you're taxed disproportionately higher than someone that has a high income. So this is the big issue that I have is the narrative from the current government is that we are doing this for the next generation. When the next generation won't have access to negative gearing, won't have access to the 50% CGT discount, but will be paying more, a lot more, than this. And another thing is it disproportionately impacts lower income earners, which
Yep.
is just sad. So I just think I'm really riled up about this. So as you can tell, because normally I'm pretty chill and optimistic, but um, I just hope that it gets watered down really, really far because like my everyone can have their opinion in the chat. We're all trying to be respectful today, just respectful of other people's views. But the the key thing is that if you're trying to save with ETFs and income, like you're trying to save for a first house and that sort of stuff, or you can't afford to get into a property. The reason you probably can't afford to get into a property is because you can't afford to get into a property. And so I'm inclined to say we should be helping more people get into the investing mindset to help people save and invest in ETFs or whatever we're going to talk about next. And I just feel like this is pretty tough pill to swallow for anyone. And that's, I've got to say, I'll admit to everyone, I'm above the 30% tax threshold. So for me, it is what it is, right? But for everyone that's not, I just think it's a misdirection. That's my 2 cents. Stephen asked if you, I don't know. That's just my rant,
I
Hayden.
think you're
But
pretty right on that generally, like for sure. That I think the 30% floor is quite punishing. I don't, that was the surprise of budget night. I can't say I'd see why they're doing that. They make
mm,
reasons about it, but I think it just seems so kind of
yeah,
absurd and far-fetched. And just to be clear, Owen, too, whilst I think the CGT changes make some sense, I don't understand why it didn't extend uh, just to property, just to existing dwellings. Like it seems very punishing to the rest of the economy. And also, I know people get panicked, Owen, about the CGT changes on properties, but most people, particularly most people who are struggling, their property growth has not been doubling inflation, a lot of
that's
the
it.
time.
Yeah.
So yeah, I think they have definitely overreached a couple of these things
Cool. Now we won't go on the tax and
for
budget for too
sure.
much longer. We'll get to the things that everyone loves. But if you can go and have a play with this tool, it is available. We can paste the link again into the chat. It's just a good way to understand it. And I think maths is a beautiful thing because it does bring science to debates and public discourse. So definitely go and check that out. And remember that it's not yet legislated. So you can um, effectively petition your local member of parliament and say, hey, yeah, maybe negative gearing, I'm okay with that. But this other stuff, it doesn't make sense. Why do that? You can let them know. Like, feel free to write to them. I'm saying this because I'm not one of those people, but feel free to write to them and let them know that, hey, I use ETFs. I don't use property. Why am I being punished for this? Or whatever the case may be. So Hayden, this is really great. I really appreciate you doing this. Now you do have a podcast coming out on is it Saturday with Dave?
Yes, I just finished that. We spent an hour and a half talking about the budget and all the details. So feel free to check that out on the Aussie Fire Pod.
Aussie Five podcast. You can get it on Apple, Spotify, YouTube, wherever you get your podcasts. You can check out more of Hayden. He's him and Dave, absolute duo, fierce duo over on the Australian, the Aussie Fire podcast, I should say. Really check it out. Great, great listening. So there you go. It's also in the chat now. Hayden, mate, I really appreciate you stopping by. I know you've just been
Great.
recording. You come into this, go have some lunch, keep
Yep.
building the cool stuff for everyone at Perla, and we'll see you on the next one.
Thanks so much, Owen, and thanks to everyone. Enjoy the rest of the webinar.
Thank you, mate. Cheers. So now I can see folks saying, will this be recorded and sent out? Yes, it is recorded. It's also on the Perla YouTube channel. So definitely check out the Perla YouTube channel. Obviously, it's free. This will be recorded. The last one's on there where we talked about getting started in ETFs. The purpose of today's session is not about pure beginning in ETFs. That was the last show. So go back and check that out on the Perla YouTube channel. That said, if you are here for good ETF talk, you'll be very welcome, even if you are a beginner, because I'm going to answer your questions as we go. So definitely pop your questions in the chat. Now, I did leave a bit of a teaser in the email, in my email to the Rascals, and in the Perla email from Zwei. That was also leaving a bit of a teaser of what kinds of ETFs we might talk about today. So, one more hint, not beginner ETFs. We spoke about VAS and A200 and VGS and all that IVV stuff last week. Snooze fest, boring, move on, right? What are we going to talk about today? I want you to try and ping me in the chat with some of the things. Oh, okay. FI Wells is the first guess that I can see, and FI, you did nail literally the first one on my list. So yeah, AINF from Corey. It's not on my list. It's unfortunately not on my list. Qual from Ray was in my top 10, but not on my list. RIIF from Ben, not on the list, but good pick. MVR, no, good one. VAE, no, but it's a good one. NDQ, not on the list. Too popular, too good. Fang, very close. Wire, not quite. Not the copper. Jenny's gone with EMKT. Not EMKT. As much as I'd love to brag about buying EMKT a year ago, Paul nailed it. David's nailed it. Oh, PM Gold from Anne, no, but it's a good one. LHJG, no, Andrew, but close. Okay. So I'm going to bring ESPO, Esports Online, says Nick Nicolaides / Sway in the chat. So Esports Online, fun fact, people that play and watch esports, so esports where you watch people play video games on Twitch or whatever, are on average 20 years younger than people who watch actual sport. Think about that for a second. Esports viewership 20 years younger than people who watch actual sport. The kind of AFL, EPL, rugby fan in me is like, what is that going to mean for actual sports in 20 years' time? What do you guys think? Anyway, let's move on. I've got some slides here. I did have a bit of a chart reveal of Hayden, which I can show you guys. Here we go. So I'll bring my screen up. I don't have too many slides because I want to get on the kind of like more doing with you, so less kind of. Oh, there we go. You guys can see my screen, okay? I want to show you things like more practically, rather than spend too much time going through boring slides. Yeah, you can see it. Sweet, thank you. So I've done a bit of a silly title here. 7 ETFs no one knows. People know these ETFs because they invest in them. So some people do know them. We are talking about ETFs now that we're off the politics bandwagon, where basically no defamation or financial services laws apply. We are talking about serious stuff from here on. So here's a general advice disclaimer. We don't know your needs, goals, or objectives, so be sure to speak to a financial planner before you act on the information. If I do mention ETFs and these types of things, just remember they have a PDS, product disclosure statement, and TMD. A good example of that would be, I don't know, what did someone say before? What was an ETF? RBTZ from Natalie. So RBTZ ETF. Okay, let's go to the BetaShares website. I'm not going to click on the Google ad as much as I like Google Shares and want to reward them. So when you're on an ETF provider's website, you can scroll right down the bottom typically, and you'll find all the stuff you need to know. For folks that don't know, the PDS is like the one that's like T's and C's, fees, potential tax consequences, potential risks, that sort of stuff. This one here is the TMD. This is a recent one. You don't really hear this on the TV or radio. The TMD is actually probably the more useful of the two nowadays. And what it actually shows you is it shows you who they're trying to market the ETFs to. So who they're trying to market it to, whereas this is what is the darn thing. Now with this one in particular, you can actually see that they've bundled multiple ETFs together, including their most recent one, which came out like this week, Rocket. You can see the different ETFs, and if you scroll down, you can see fees and this type of thing. Now, I know we're talking a bit more in depth today about ETFs, about how they work. So if you want to ask questions as I go through this stuff, please let me know. Please share full screen. Good call. I'll just zoom in a bit. I might even go a bit more like this. I'm on a very wide monitor, so hopefully you can see that. Hopefully that's better for you, Francesca. Please let me know if it's not, because I want you to be able to see it. So when you're in a PDS, you can see all of the stuff that no one really cares about, but it's important. But you can come down and you can see things like this, like the investment strategy, what they actually do, etc. If we go back in an ETF, into the ETF page, you can see this thing, the fact sheet. This is updated every month. This is the one that, for me personally, is the most useful, because I know the ETFs pretty well now. I don't need to go back into the PDS every time. But this is the one that's most useful to me. It gives you an overview. It's like the executive summary of the PDS kind of thing. The regulator probably doesn't want me to say that, but you get the drift. So you can see all the different bits and bobs in the main part, but I like this stuff down the side here, because it shows you like the valuation of all the stocks inside the ETF. It shows you the average size. So in this ETF, there's $766 billion. That's really big. That's bigger than any Australian company ever. So you'd be asking, well, what's inside it? They must be massive. And so you can see all these huge companies here. Intuitive Surgical is one of my favorite companies just because of what it does. For those of you that don't know, it does the Da Vinci machine, which is this robotic creature that operates on human beings down to like millimeter precision. It can peel a grape, which is probably important if you're doing prostate cancer removals. Let's be honest. But that is like a wonderful, fascinating company that I personally have followed for many years, for probably at least 10 years now. And oh, the stock's down. That's actually pretty good. But here's how it's performed over a very long period of time. I didn't actually notice that it was down the last month or so. That's pretty brutal. That actually gets me excited to, oh, PE ratio of only 24. Oh, okay. Interesting. I didn't know it was down so much. Does anyone here in the chat own Intuitive Surgical? Oh, sorry, this is Intuit. Sorry, wrong one. iSurge. What am I doing? This is it right here. No wonder it's not that cheap. 52 ratio. So this is the performance of the company over time, and it still has fallen too, probably because of the AI thematic. But does anyone own this business? Anyone at all? I'd be really fascinated to know. Okay. Anyway, let me know. So that's how you look at a PDS and a TMD. I just wanted to kind of get that across your desk as we go and research these next ETFs. Final thing that I'll add is if you click this link right here, the one that's got the portfolio holdings, that actually downloads a CSV, like a Excel file, and you can see all of the stocks inside it. So here you can see the top 10. You can go click this all button and it will show you all of the ETFs. The only time an ETF does not show you everything that's inside it is if it's an active ETF. Someone brought this ETF up before. So when you see active in the title, legally, they do not need to tell you all of the different holdings inside it. So there's this kind of belief that ETFs are good because they tell you everything that's inside the ETF. That is true, asterisk, except if it's an active ETF, they do not need to show you. So that's one of the key points. Kirsty says, I think most of the robotic surgery has peaked as most hospitals already own it and it is very expensive. The major outlay is the machine itself, but this will peak at some point once most hospitals have the main body of equipment. So interestingly enough, Kirsty, you are right that it is very expensive to get the intuitive surgical robot into your hospital. However, my understanding is they can cost $1 million a year to keep them in the hospital. And if you've trained a surgeon, you've trained very safe surgery through a machine, I would hazard a guess that people are less likely to, or hospitals are less likely to give it up. So that's one of the things to keep in mind. David did ask a question before. Do these 7 ETFs have high daily volume, tight bid-ask spreads, and the fund size over at least 300 mil? Otherwise, I'm probably not interested in buying them. Obviously, I know some would pass this criteria. Great set of criteria, David. Really great set of criteria. So I'm going to unpack that really quickly. And I want to probably talk about this. So you mentioned a few things. High daily volume. I'm going to give you a shortcut to something. So if you guys were to go home or after you step away from this chat and do something way more interesting with your day, like eat some Vietnamese food or speak to someone on the phone or tell someone a good finance joke, what you can do when you're lonely one night is you can Google ASX ETP monthly report. And you'll go to the ASX website and you can choose between an Excel or a PDF. And just to prove I'm not biased, you can also do it for SIBO. Oh, geez, that's not good text. Monthly report. What am I saying? So SIBO, which is the other stock exchange in Australia. I know we're learning new things. There are more than one stock exchange. Yes, there are. There's the ASX, SIBO, and does anyone want to guess what the other stock exchange is? Can someone else guess? We have a third stock exchange in Australia. I would love to know. Um, Tell me if you think you've got it. Jonathan in the chat says for Intuitive Surgical, Consumable and upkeep is expensive. I think the real issue is whether China can make a cheaper option to replicate the Da Vinci machine from Intuitive Surgical. Okay, quick rant on this. Quite a few years ago, um, this company, who many of you may know, Cochlear, this company has been absolutely whacked recently, right? Look at this. Whoa, okay. Quick one on this. Look at that chart. Gee willikers. So, about 20, this period in here, we'll just say it's somewhere in this area, 2010 to 2015. Cochlear, which makes implantable hearing aids, that's not a hearing aid that you just wear when you go out or if it's, whatever. This is a hearing aid that actually gets bolted into your skull. I know, great, little bit TMI, but here with me. A few years ago, Cochlear got sold down because people thought China could replicate the cochlear implants, which take surgeons years to learn how to implant, audiologists many years to train on and to recommend, and for people to go through months of recovery. People thought, oh, China could do that. Maybe, but here's the rub. If you're going to get something screwed into your skull, you probably don't want the one that's just been knocked off from China. You probably want the real one. And lo and behold, Cochlear went from, after it fell down to like $50 until recently, it went up to $300. So it's really important that when we think about competitive threats and risks, we ask ourselves, what is the true essence of the risk? And what does the consumer think? Not do we think as investors, but what does the consumer think? Now, back to the point about competition. Absolutely, competition could come for Intuitive Surgical, but the robots are already in the hospitals and it already has competition from Philips, but Philips is hopeless. So that hasn't worked. There is something happening with ResMed, however, which is another popular Australian company, which does sleep apnea masks. The things that make you look like Freeze, for those of you that know Arnold Schwarzenegger in that great movie, that make you look like you've got some weird attachments on your face, or like Bane from Batman. There is competition coming for ResMed, but this business probably isn't as resilient as maybe Intuitive Surgical or Cochlear might be because it's not as personal. It doesn't get up in your grill. All right, so people have guessed, and I can tell you one for sure. I like this comment. Andrew says CSL and Cochlear are screwed currently. Um, so Kylie says the NSX. Thank you. Thank you. You got it right, Kylie. The NSX. So this is okay, this is fun, right? Hear me out, guys. So the NSX is the National Stock Exchange. It is the smallest of all the stock exchanges, but it itself is listed on the ASX. So the third biggest and smallest of the major stock exchanges is listed on the biggest stock exchange. I don't want to get in people's like business too much, but that tells me something. So the NSX is the third largest. The second largest is SIBO, used to be called CHIX, CH-X. The biggest is the ASX. But I just wanted to remind people that there are more than one stock exchange. And some ETFs aren't on the ASX. Some are just on SIBO. So that's one thing to keep in mind. Okay, so let's go back to what were we talking about? David's point from before. When you click on this report, it actually shows you some really interesting stuff. If you're a bit more of an advanced user, you can jump into the Excel version and chuck it into Claude and have a play around with it and do whatever you want. Just don't trust Claude for your ETF research or any type of investing because it hallucinates more often than not. But if we continue down the page, what we can start to see is a list of all the different types of things on the stock exchange. And it says it actually right at the very top. It says here, ETPs, I'll explain what that means, M funds, LIVs, I think that may be supposed to say LICs, A-REITs, and infrastructure funds. Now, what these are different types of investment funds. So an ETF is one type of investment fund. You can go on and buy RBTZ or DHHF or VDHG or STW. or whatever. But if you actually, they actually form this category called ETPs, exchange traded products. Hell of a name. But you can see for the month of April, there was $335 billion invested in ETFs. $335 billion for a total of, I think that's average monthly transactions, I think 1.5 million transactions. Um, if you go the number of admitted onto the stock exchange, 446, the total number. Thank you for correcting me there, David, on the live. I've seen it as lits in this report. I wasn't sure what they were categorizing it as. So in the last month alone, we can see that 1.5 million transactions happened. David actually brought up a third point before where he talked about the buy sell spread. I'm going to explain what that means and then we'll start cracking on with some of these ETFs. So on this page here in front of us, what you can see is all of the ETFs down the side. So you can see all of the different ETFs Australia currently has to offer on the ASX. There are some more on SIBO. So you can see them all there. And then across the top, you can see the fees, the FUM, which is the amount of money inside it. You see the inflows, outflows. If you keep going across, you can see transacted volume and value. What this is saying to you across every stock brokerage account, not just Perla, but all stock brokerage accounts, how much buying and selling happened, how much in billions of dollars or millions of dollars, mostly billions for the bigger ETFs, and how many individual transactions, right? You can see them there. You can see the number of individual trades, buys or sells. You can see the spread, which is this part here. The spread, what it measures for you, so you don't have to calculate it yourself because you'd never be able to, is it calculates the difference between the sellers and the buyers every minute of every day. So at one point in time, let's say we've got Lake House here, we can see that its current share price is $1.48. Now, if I was to go into my brokerage account like Perla and say, buy this ETF for $1.50, my order for that ETF would fulfill almost instantly. Because what would happen is I'm making an offer to buy shares that's above the market price. So I'm saying I'll pay you $1.50, current share price $1.48, buy. And it will go through almost straight away. But if I set my order at say $1.45, which is 3 cents below this, my order probably won't go through immediately. It might go through sometime during the day, but not immediately because I'm not at the market price. What the bid-ask spread represents, and this is an important understanding, is what it represents here is the average difference between buyers and sellers when they're buying and selling. So the actual reality here is the smaller this number, the better it is for your money. So you can see here that some ETFs, like this first one from A200, is really, really tight, meaning good. U300, A300, which is from GlobalX, not as tight, which is not as good. Why? Fewer buyers and sellers, but also it's a newer ETF. So keep that in mind. And you can go down, you can see that most ETFs have really tight buy-sell spreads. This brings me to David's final point, and thank you, David, for playing along with me. He mentioned that maybe an ETF should have at least $300 million invested, right? Which is this one right here. $300 million invested. I used to use the same rule of thumb when I started following ETFs in 2013, or 2013, 2012, 2012, 2013. Whenever I started talking publicly about ETFs, I used to use the same rule of thumb for most people. So I used to say to people, wait until the ETF is bigger. Why? Because of this buy-sell spread. But what's happened is technology has got so good in Australia, the financial system has got so good that it's no longer a big deal, in my opinion. So you can go and buy these ETFs and analyze them, not really worrying about these things. Now, I know we've gone pretty far deep into the weeds here, so I don't want to really go too much further into how the overall market works. But what you need to remember is that when you are studying ETFs, typically bigger ETFs with more money inside them tend to be more efficient, tend to be easier to transact, buy and sell, and tend to track the index better, the thing that they're actually trying to do. Okay, so some good comments in here, mostly about the difference between sleep apnea and hypertension and Wegovy. That's cool. Mark says, "How flawed is my approach if all I did is pick three ETFs from CanStar's top-rated ETF website and invest in them 6 times a year on a regular basis?" Well, you know what, Mark? It really does depend. I don't know what those ETFs are. And it would be really important for you to make that informed assessment if you're not using a financial advisor, because while it may make sense to do with what's popular, like I just said before, there are reasons why popular ETFs are popular. But the reality is, it's not that simple because everyone's different. Everyone's a little bit different. So, and the ETFs, just because they're popular doesn't mean they're good. Like I can tell you, some of the most popular ETFs right now are space, copper, um, AI, silver. Those are the four most popular kind of themes at the moment. I don't deliberately invest in any of them except one. Um, and I think that one of them is way more impressive than the other. You can probably guess which one um, I'm talking about. So David made a comment here. Great comment, David, about GRPA, which is the ETF right down here, which is an ETF that no one really talks about. Where am I? I've just lost myself. Sorry. There it is. So the Global X Australia GARP ETF. The reason this ETF is still tiny, and that's because it's brand new. You know, it's very, very small. That doesn't mean that it's a bad ETF though. So you kind of need to look past that a bit. Um, we can see there's another question here, which is a good one. Lindley asks, how do you invest in all stocks, in all stocks in Australia and in all markets? So the good question, this is a really good point. Something people don't understand about how stock brokerage accounts work. When you click buy or sell, I'll see if I've got my Pearler account open up here. So when you click buy or sell, there's my email address for anyone that wants that. Um, what actually happens is when you click buy or sell, most brokerage accounts, and Zwei in the chat or someone in the chat might be able to tell me what's what. But say, for example, what was the ETF we were talking about before? GRPA. So when you come in here and you click buy, what actually happens is a lot of the time the stock brokerage account that you're using, in this case Perla, they actually decide where your trade goes. Does it go to the ASX or does it go to SIBO? And that can happen automatically behind the scenes. You don't even know which stock market was used to buy and sell your shares. And the good thing is in Australia, it doesn't really matter because it will just normally go to the stock market that has the most sellers for your being a buyer. It just matches you automatically. So that's typically how it works. Now you can obviously use more advanced features and stuff like that here in the bot. But that's basically what happens. You don't need to choose. Now, if you just wanted an ETF that covers the entire Australian stock market, guess what's number guess what's number 3 on my list? So these are the ETFs I really wanted to cover with you today. Take a look at these, and if you have specific questions about these ETFs, I'm happy to answer them. So take a look at these ETFs right here. This is the ETF I'm about to talk about. And while I draw my breath and read a couple of questions, um, Fayam has asked, I started investing at the start of the year. I've been investing consistently every month. How important is it that I get a financial advisor? And if so, are they expensive? I've written a lot of articles about this. I'll show you the article, Fayam, in case you wanted to know it. Financial advice costs, Owen Rask. That's great, England. So I'll just pop this in the chat. You can just go and read it in your own time. This explains how financial planning fees work and how they don't work. And if you use ChatGPT, how they work. There's a big graphic here. You can go and read it in your own time. But in short, the key point is this. Don't see a financial advisor because you want stock tips. That's not what they should be used for. Financial advisors are not for stock tips. If they try and convince you that they are, they're not. Walk away. They are for everything else. So they'll help you invest in stocks, they'll help you invest in ETFs. But if they're saying, I will do this for you in buying individual stocks, be careful. Go and look at them from the perspective of everything else they do. Now, obviously, I'm biased because I have a financial planning firm. It's called Rask. Shocker. Um, you can go and read that article in your own time, but that's basically how they work. So, yeah, good question from Diane. A good point is like with the financial advisors, making sure that they're not just trying to sell you something. Like they have to be for you. They're working for you, not for themselves, right? You're the client. So remember that. Cool, cool, cool. Ray says, love FHNG. Hey, Ray, I've got a question for you. Follow-up questions are allowed today. Um, why do you think I chose FHNG for the list, Ray? I would love to know what you think. So that's that one there. We're about to talk about STW. Um, Josh says ACDC is doing well, but for how long? Let's go into SCW. So most people in Australia know that you can invest in really popular ETFs that track the Australian stock market as a whole. So the most popular ETF in Australia by like the longest possible margin is this one right here, which is the Vanguard Australian Shares ETF or VAS. Now the thing is, VAS, even though it's the most popular, it's the most popular on Pearler, is it's the biggest, right? But it's not the lowest in fee. There are ETFs that are actually lower fees than VAS. So why do people use VAS when there are these other options? One of the other cheaper options is STW. STW is this spider ETF. Look at this ETF right here. Does anyone want to know why I would have chosen STW? There's a very interesting fact about STW. Does anyone want to guess? Why would I have chosen STW? While you're doing that, I'm just going to Google something over on the side, and then I'll be able to share it with you. Okay, 3, 2, 1. Nadia says combo of S&P and ASX. Why not A200? Says Manuel. Rays loves STW, and to its credit, says Karen. Roger says dividends. Asset allocation, says Matt, question mark. Okay, you ready? STW, and forgive my spelling, I'm trying to operate on multiple screens and I've got things all, I've got my laptop currently hooked, standing on four copies of Poor Charlie's Almanac. I take Poor Charlie's Almanac everywhere I go. No, just kidding. It's just that I'm in a different room today. So STW was the first ETF in Australia, or as I like to call it, was STW the first ETF in Australia? That's the reason I did it. Australia's oldest ETF, says Luke, and he is so right. So this ETF was launched in 2001. So really important thing that happens, right? People think that ETFs are for young people, or ETFs are for beginners, or ETFs are in a bubble, right? This ETF existed before the worst financial crisis in history, measured by the total stock market return. Obviously, we've had, the Great Depression of the 1920s, which was whatever, but we didn't have as big a stock market fall then, actually, crazy to think. But the global financial crisis, this ETF survived that, as did most ETFs. So the actual fact that people think that they're new is not really a fair criticism because they've been around for the long time. So while STW wasn't the first globally, State Street's first ETF launched in the US in 1993. So these things have been around for a long, long time. Now, what does it actually do? The ETF itself is the oldest ETF in Australia, and all it does is it buys the ASX 200. It just simply buys into the top 200 stocks in Australia. I would love to know, does anyone own any of these ETFs here? Do you own any of them? Or does anyone here even own STW? I know like probably all of us own VAS in some way, but does anyone own STW? Oh yeah, there's a thumbs up there, cool. Shaq says, is it a good strategy to invest in ETFs that provide high franking credits to reduce tax? Well, yeah, probably. In general, I'm not specifically for you, Shaq, just in speaking in general financial advice terms. But yeah, the budget this week, franking credits were the only things that weren't really touched. So let's just take stock of the budget for a second. Franking credits weren't touched. People that already had negatively geared properties weren't touched. Superannuation wasn't touched. Wonder who benefits from all of that. Uh, so anyway, moving on. So why did VAS become the most popular? Ali, great question. Such a good question. So the reason I believe that VAS became most popular is because people fell in love with Vanguard more than they fell in love with STW. So Vanguard has a fantastic like marketing engine, and Vanguard were the first in the world to really embrace and push um, ETF, oh not ETFs, index funds. So index funds are the type of strategy that are inside of an ETF. I want to do a bit of clarification, if I may. I'm going to get my Mr. Squiggle out for those of you who celebrate. So I will get rid of all that junk and I will get my Mr. Squiggle out. So let's say an ETF is commonly described as a basket, right? So this is my attempt at a basket. And we'll just put a big E under it because if I tried to write the full thing, well, you'll see my Google skills before. Inside of the ETF is where the strategy lives. Ultimately, strategy. There we go. My 13-month-old son will be thinking, what is he writing? Anyway, so strategy. Here, what actually happens is you can have any type of strategy inside of an ETF, just about. So we mentioned before that STW is an index ETF, just like VAS. So STW is an index strategy. VAS, which is the big one, is an index strategy. The only difference, literally the only difference, this one has 300 companies like this. This one has 200. That's the only difference. Now you might be saying like, which one's better, which one's worse? Well, we know that STW is slightly cheaper. VAS is slightly more expensive, 2 basis points or $2 for every $10,000 invested. Not really relevant. But if we go across, I'll take this across to the side of the page. So this is the fourth row from the end. Over a 5-year period, there is not much difference between the two. So over 3 years, STW has done 10.85% of growth and dividends, whereas VAS has done 10.81. 0.04 difference. Doesn't really make sense, right? Like it's no big deal. That's why when people ask me, hey Owen, should I buy VAS, STW, A200? I'm really concerned about my brokerage as well. I'm like, who cares about your brokerage? Just buy one. It doesn't make a difference. Over the long term, it won't that make that big of a difference. You can always change as well, obviously with tax. But like this ETF doesn't get a lot of love, so I wanted to just talk about it. I don't think anyone probably here has been to the STW website. So it doesn't look like really anyone has um, owned this ETF in the chat. There you go. So I did get it. No one really has it. So that's cool. All right. So Tegan, you said, what about compared to IVV? Now, IVV is in a totally different sector. So if we compared, if I get my Mr. Squiggle back out, if we can compared STW, it might look like that hypothetically. Well, it looks like IVV would have done that. It's done a lot better, but it's not comparing apples to apples because IVV equals the United States, STW and VAS equals Australia. So both of these ETFs here, this is the important part, the educational point I'm trying to make from today, is that both of these are Australia. IVV equals USA. All right. IVV equals USA. RBTZ is global. So you've got some United States, some Japan, some China, and so on. So an ETF like that would be global. A well-diversified portfolio has a bit of everything inside of it, as we all know. So I want to come back to this idea of having a strategy inside of an ETF. Let's get that out of the way. I'm just using Canva here. Shout out to our Aussie entrepreneurs who are now going to be taxed more. So we're a different color. I don't like red on orange. It's not good for people that maybe have a bit hard of seeing. I'll go like that. Okay. So inside of an ETF, you can have many different strategies. So we talked about having Australia or the United States. You can have index strategies, which is like I just follow the ASX 200 or 300. But you can also have something called active, which was the lake house one we mentioned before, right? You can also have something called factor, and we'll explain one of these in a second. You can also have thematic. So this might be like a whole like AI theme, yippee. Or you could have sectors. So you could say, I only want healthcare companies, right? The important thing is that the basket is the ETF. The stuff that's inside it is the strategy. So if we go back to this ETF, which is a random one that we pulled up before for investing in robotics and humanoid technology, this is an ETF, like all of them are ETFs, but inside it, it has a strategy and invests in companies involved in robotics and automation. So this is what we call a thematic ETF right here. Some say it would also be considered a sector, but it's probably more of a thematic. It's like I'm investing in the theme of robotics and automation. Does that make sense? Kind of thing. So now we can move on and we can move a bit quicker through these last ones because I've gone too long, which is classic me. If we go back, the reason why I wanted to bring up Moat, MOAT, is Moat is a different ETF altogether. Moat. So Moat does two things, and I've followed this one basically since it was born. I feel like I'm like kind of like the godfather of it, but like an adopted godfather. I've followed this one since it launched way back in 2015. I owned it for many years. I don't own it anymore. But what this ETF actually does is it combines companies that have good competitive advantages. So we'll feature some of those companies. Where are we? Where are you, companies? Here we go. So it features companies that have good competitive advantages and the valuation is good. Valuation good, defensive features good. So when I say defensive, I don't mean like they're making armaments or something like that. I mean that a human being has gone along and just said, oh, that Airbnb thing, that's actually got a really good market position. It's a really interesting company. It's probably going to be more insulated from AI than Booking.com or whatever the case may be. Someone has gone along and said, I like Mondelez because I like to eat all the food that Mondelez produce, which is a lot, by the way. Google Mondelez brands and you'll see what I mean. Nvidia, that's the world's GPU company. That's really defensive. So there you go. So that's why a company gets on the list. And effectively, this is an example of a multi-factor strategy. And what effectively happens for Moat, we'll put this up here. Moat effectively says, get all the companies in the United States and the ones that our analysts at Morningstar say are good for defense, and I'll try and draw a little castle. Me drawing a castle is not a good thing. So we'll say like this. This is my attempt at a castle, and it's got a big door, and then there's a bridge across to a moat. Jesus, I could be on Sesame Street at this stage, right? So Moat says, get all the companies that have strong defensive features, right? It also says, let's pick the companies that have good valuation. So if you've got good valuation and you're a defensive, you can go in the portfolio. Everyone else, no thanks. So this gets its name from the ring of water that goes around a castle. This is the moat. And the reason why it's called that is because Charlie Munger and Warren Buffett talked about this idea of having a moat or a defensive feature around your castle. So it combines both of those. It combines the valuation and that. Now, the reason I actually sold it, don't show that to your son. Yeah, I don't know, he'd probably make some sort of random noise that I wouldn't understand. Now, this ETF has actually done quite well. It did go through a bit of a bumpy patch there, but like, frankly, who wouldn't be happy with the 10% returns, the 13% returns? However, it hasn't done as well as the S&P 500. So I own the S&P 500 as well. So yeah, Moat is down, you say? Moat is down 7.7% over the past year, says Frank. Oh, you may be looking. Okay, so one quick clarification here, and Corey, maybe you're alluding to this as well. Um, so, and Jennifer, quick one for you too. So you say, why are you recommending Moat if you don't own it yourself? for avoidance of any doubt, I'm not recommending these ETFs. I'm just bringing them to you so you learn that there are different types of ETFs. I am in no way recommending these. I'll tell you if I own ETFs just purely for disclosure. I'll tell you if I don't own them purely for disclosure. I'm not recommending you to do it. It's just purely for education. Um, Important to understand. Now, we do make recommendations as a company. We give financial advice. We invest for people, but I'm just trying to be educational. It's important that people who are in my position don't just talk about the things that they own. Because if they only talked about the things that they owned, they would be incredibly conflicted. So really important nuance that. Now, back to the other point here. Um, do, 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 do. Oh, okay. So with all of these ETFs, it's really important to understand what you're getting and what you're not getting. So Gabriel wrote about why is it really worth owning an ETF like that when you already have it covered in other ETFs. Effectively, in your portfolio, you can have as many ETFs as you want. But if you divide it up, you might say, I've got this much Australia, right? And I've got this much global. And then you might say, I've got this much in bonds or something defensive, just hypothetically, right? Then you say, well, if I added this other ETF called MOAT and it does global shares or international shares, mainly the US for this one, you're saying, well, it's this slither here. Why would I add those companies if I already have this many? It's about understanding the mix, or some people call it the overlap in your portfolio. So you're probably right. You don't want to have too many of the same ETFs or too many of the same stocks. I often say to people that 5 to 10 ETFs for most investors is probably enough. If you want to be a bit more diversified, you can. Um, but yeah, final thing is you can get this on this recording on replay. So I'll finish off the last few ETFs, and we're back in a few weeks, guys. So remember, we do these webinars on the Perla YouTube channel every few weeks. So just subscribe to the YouTube channel or to the mailing list of Rask or Perla, and we'll fill you in. Okay, let's move a bit quicker. Let's Google IXI. Why did I want to bring this to the table? Because this is a company, sorry, an ETF that has companies that you probably use every single day, or at least you know, but no one owns this ETF that I can see. Like no one really in our community really wants to own it. It has performed poorly over the last little while, but you probably heard my monkey brain before. When I see something going down in value, I tend to get more excited if the things are good. So, I mean, the standard analogy is if I got a bar of gold and I put that gold in the bargain bin at Coles, everyone here would be like, whoa, check that out. It's cheap. Get it. Right? But in the stock market, when we see something that's gone down, we think, oh, very bad. Must not be good gold. Right? It doesn't make sense. We see stock price goes down, ETF price goes down, bad. No, that is often the time that you want to start thinking about using a diversified portfolio to learn more about it. Walmart, which many of you know is the USA's Bunnings, not Bunnings, like diversified retailer. Costco, which is amazing for those of you that don't go to Costco, like hurry up and get a membership. One of the biggest companies in the world, top 20 companies in the world. Would you believe it? Procter and Gamble does like basically everything you put in your bathroom. Philip Morris, if you want to smoke ciggies, go check out Philip Morris. Believe it or not, when I speak to fund managers from around the world, they're like, you guys here in Australia, you really have a problem with cigarettes. It's like, yeah, of course we do. But in most parts of the world, it's still kind of happy days, right? Coca-Cola, Nestle, Pepsi, Unilever, really fascinating and amazing businesses, right? And recently it has fallen. And so I wanted to bring this to everyone to show, hey, you can see these companies, they're not that expensive and they're amazing businesses. Yeah, they might have fallen recently, but are they going to be resilient in a world of AI? Probably. Do people still shop at Costco? Absolutely. Really, really, really interesting ETF. It's for more of a kind of side part of your portfolio. I'll come back to DACE in a second. Does anyone know this one? VISM? So VISM is the Vanguard MSCI International Small Companies Index ETF. This ETF, not that one, because it's not going to show us what we want, that one. What this shows, what this does is it's from Vanguard, and it's an ETF that effectively just buys smaller companies, right? Why would you even consider an ETF like this? you might be inclined to use an ETF like this if you believe that smaller companies are going to grow faster than bigger companies. So pretty interesting. This is VISM. Um, Jacob, just so you know that I'm talking about VISM uh, on here. So VISM is investing in companies that you probably don't really know too well. Did I just get the fact sheet or did I not? Portfolio data. Here we go. So if we go in, we can see the valuation methodology. We can see the return, like the growth rate estimated by these ETF, by the companies. So the growth rate is a fantastic one to judge small companies, right? Because for small companies, we want it to grow fast. That's the whole idea. So Vanguard has crunched the numbers and it said, based on the companies that we have in the portfolio today, what is the estimated asterisk, growth rate in the profits per share? We call it EPS, earnings per share, but earnings is just a fancy word for profits. Profits per share. 11% profit growth over time. So then it's no wonder that over the long term, an ETF like this does really well because effectively it's showing us that, hey, you can get these growing companies in one ETF pretty quick and easy. But no one really talks about that. Everyone talks about VGS. Boring. I mean, great ETF, but come on, let's have a bit of fun in our lives. Um, but seriously, these aren't recommendations. Just obviously, we're having a bit of fun and trying to learn about different structures. So effectively, what VISM is saying is we are just going to target small companies, or at least smaller than the big ones. So we're just going to put small companies inside the ETF and exclude the big companies. Believe it or not, this is what we actually call a factor ETF. We're saying the size of the ETF is a factor, or sorry, the size of the company is the factor that we want. So that's VISM. And feel free to ask any questions. I'm going to fly through these. There was a question about cigarettes before with Philip International. Let's ask ourselves a little bit about FAIR. So FAIR is an ETF that is mainly playing into the more what we might call responsible investment or or ethical investing or sustainable investing. So this ETF, the reason why I wanted to bring this to the show today is the ETFs that no one talks about, right? 5 years ago, everyone was talking about ethical investing, responsible investing, climate change. Now, obviously, everything there is a lot. Climate change is real for the deniers. Just do a little bit of science, you'll figure that out. But the reality is that ethical investing has got a pretty bad rap over the last few years because the performance wasn't as good as people were expecting and so on and so forth. However, sustainability is very different to ethical investing. We've got a course on this, and the way I taught people how to think about it is ethical investing is to do with your personal values. Sustainability can be measured. We can measure that with carbon emissions. Now, the 1 year performance looks really bad. So there's probably going to be someone in the chat that says, hey, really bad performance. Why would you buy something like that? Again, it comes back to why I'm interested in companies that have, bad performance because I'm thinking if that is only temporary, why wouldn't I buy that? There's a famous study called the Delbar report that's been going on for 35 years. And basically what it tracks is how well do investors do inside the ETFs that they own or the funds that they own. Investors do worse than the funds that they invest in. You might think that's a play on words. It kind of is. What it actually shows is that on average, an investor in a fund does 2.8% worse per year than the fund itself because they've always panic sell. Be greedy when others are fearful and fearful when others are greedy, says Corey. That's right. But most people aren't that. Most people are fearful when the share price has fallen and then they sell at a loss and they get it the wrong way around. So, yes, something to think about. So, Gabriel said VISM is good, but a lot of exposure, US exposure and fees. Any other alternatives for small caps? There are other alternatives. VSO says Eswara. So VSO is very different. VISM is for international companies. So if you wanted like global companies from outside Australia, VSO is Australian companies. So this is Australian smaller companies. Also a good ETF, but for different markets. So continuing on, um, I'm going to quickly go, maybe we've got two left. I'll go to FANG. So most people know this ETF. It's the most popular, I think, or second most popular from Global X. That's the ETF provider. When most people come in here, they'll be looking at the ETF being like, oh, wow, it's performed really well. Look how good that is, et cetera, et cetera. They'll say, oh, the 1 year performance has been pretty good. 14.8%, pretty good, right? Now, the thing that people don't understand is most ETFs can have both a currency hedge and a not currency hedged ETF. I'm going to be quick because I know people are going to run off to lunch and stuff. This ETF, all it simply does is it takes like the 10 biggest stocks, tech stocks in the United States, puts it into one ETF. So instead of going into a brokerage account and going, I'll buy Amazon, I'll buy Alphabet, I'll buy Apple, this ETF does that legwork for you. However, it has a sister. The sister of this ETF is FHNG. This is the same ETF, but it's got one difference. It actually currency hedges. So it takes out the impact of the Australian dollar bouncing up and down. And what you can see, and the reason I use this example today, is that this ETF has done 28% or 29% returns in 1 year, whereas its brother, the exact same ETF, has done 14%, 15, half. And this is a thing that most new investors don't understand is the role that currency hedging plays in your account. Now, I really like this ETF because it gives you exposure to growing mega cap, big US technology companies. However, it doesn't like have any impact from currency. So it's quite interesting. Daniela says, a good question. I thought hedging was more cost than benefit over the long run. Over the long run, the Australian dollar has averaged between, depending on which time period you use, over the long run, Daniela, the Australian dollar has averaged low to mid 70 cents. So somewhere between 70 and 75 cents US is typically where we sit. And at the moment, we're kind of smack bang in the middle of that. So it's up to an individual investor or their financial advisor to decide where they kind of how they kind of treat it. But I like created this page on our website. It's pretty crappy, but it's a pretty old one. But it actually shows you the long run trend of the Australian dollar. Most Australian investors over the last 10 years, since 20, say, we'll go 2012. So if you've been investing less than, say, 15 years, you probably don't know what it feels like to see the US dollar um, weaken against the Australian dollar. For your investing life, you've only seen the Australian dollar falling from all the way up there. What that means is that boosts your US investment returns. It boosts your US investment returns when the Australian dollar falls. But if you think about it, there have been periods in Australia's history, like from 2000 all the way up to 2011, very long 11 years, where it went the opposite way. So some people would argue that currency hedging is actually important if you actually think about it. So that's why I wanted to bring in FHNG. And finally, this company, this ETF relates to this dude right here, DACE, DACE. This is what people probably don't know. So the biggest ETF provider in the world is this company, I believe. It could be just the biggest. This is the final ETF of the day. Could be just the biggest active ETF provider. Over $1 trillion. This is the only ETF provider that I've ever come across. Maybe there are others that I don't know about that have never closed down an ETF. So never closed down an ETF. This this is a very, if you go and Google, this is for anyone that wants to go even further with their advanced investing. But if you go and Google this podcast on our network, it's called Dimensional. You just Google Rask. This is slightly higher on the intermediate to advanced scale of investing knowledge. But if you go and Google this, there was a fantastic interview between my colleague Mitchell. This is Mitchell here. and he talks to Banu Singh, this guy here, and he talks about like the evolution of science and mathematics in investing over time. And he talks about it from the perspective of this company called Dimensional. Go and check it out if you really want to go to the next level. But basically, they use academic theory and then wrap it up like what you should invest in and put it inside an ETF. So that would be, if we go down to my Mr. Squiggle, that would be in here, right? And what they do is they do factor investing. They use mathematics to determine which stocks should go in and which ones should go out. Now, I know that I've spoken a lot today. I didn't want to go this far over time, but I just wanted to introduce you to much more advanced levels of ETF investing. Last 3 weeks ago, beginner ETF. So a little while ago, there's this one right here. I'll just bring it up. I'll put this in the chat. So if you wanted to go back to the basics, you can. In this video, which is available on the Perla YouTube channel, we spoke about ETFs at the most basic level. And you can go back and you can have a play around with that. And you can see if that's more your level. We've got so many webinars that we want to do. We were a bit interrupted by some budget talk this week, which is fair enough because it's kind of shocked everyone. But please subscribe to Pearl's YouTube channel. If you're on our mailing list or you're on Pearl's mailing list, you can stay tuned for the next session. If you do hold these ETFs, like I'm not saying that I don't recommend them, just to clarify what I meant before, I'm just not recommending all the ETFs that I talk about. I want to kind of bring you new ideas. And I can see here some last minute questions. What has their return been over time, says Nadia, who was asking about Dimensional. There's so many available on the Dimensional website. I'll just put a link in the chat. There you are there. And it will really illustrate too that you can have one ETF provider that does so much in the scientific and mathematical realm and have so many different ETFs, and they all do different things at different times. And that's the science behind investing. I can't see your links. I just put it in the chat, Nadia. I hope that you can get it. Oh no, I'm putting it. Here we go. Hopefully it's come through. Oh, I can't send them. Oh, Zway, I wonder if you could maybe repost my link there for me because I think my links are only going to myself as the speaker of the day. So if you could do that, that'd be great. Otherwise, I will send them out to you in the mail. And then I'll send you one more thing, guys. I'll send you the financial planning fees and costs explained one. There we go. If you can please reshare that one too for me as well, that'd be great. That explains how financial planning works. Now, any ETF that you would like us to keep an eye on, says Cornell. Yeah, so I think a lot of the ETFs that I spoke about today would be good to keep an eye on. One of the ones, maybe if I was to pick from my list today, I reckon if you were interested in going and investing and thinking about maybe more like you want to take a more calculated approach to your investing, I'm not saying this is a recommendation. Two of the ETFs that stand out to me today. One would be IXI. IXI is a ticker symbol. That's the one that does consumer staples only. So Costco, Walmart, these types of businesses. It's just a really interesting way to immerse yourself in how you can invest in ETFs that do something that's not just all of the stock market. And the other one that I would get you to learn about is FAIR, FAIR, FAIR. This is the ethical, or more aptly, the sustainability focused ETF. I didn't really get much time to explain how this works, but it does two things which are really fascinating. One is it says any companies that are in the naughty industries, like guns and pornography and all those ones that they call sin stocks, those ones are excluded. So let's just get them out of the way. But then what it does is it uses some process that we call positive screening. And it will say, not only are we going to exclude the naughty stocks, we're also going to we're going to pull in more stocks that are doing the right thing. So things that, in the opinion of the ETF, an index provider, in fact, do good for sustainability. So not just are we going to exclude the bad, we're going to try and pull in the good. And that's how it constructs the portfolio inside of the ETF. And I think it's fascinating if you want to learn about ETFs. It's just a really good way to do that. lots and lots of questions streaming in. Callum, you just asked a great question about GHHF, GNDQ, both geared funds, a bit more um, higher volatility and a bit more risky for me to comment on really quickly because it doesn't require an extra disclaimer from me. But fascinating ones to go and learn about too, because they're very new to a lot of Australian investors. We've had them for a long time in the financial planning side, but not so long on the individual investor side. Guys, I don't want to take up too much more of your time. Really love chatting today. I hope that everyone that needs to go back and watch this the second time, it's valuable for you. You can find me online, perla.com. Plenty of information on the ETF pages on Perla. 87% of people that use Perla, 87%. I think it's 87, not 89, 87% buy ETFs. It's pretty amazing. So cool. Thank you, everyone. I'll be back in a few weeks to stick around for the email that will come in your inbox in the next couple of weeks and give you a heads up on what's to come. And next time, bring some tomatoes or something. Like throw some heat back my way. I love that stuff. So we'll see you in a few weeks, guys. Happy budget week. And hopefully, may the tax lords be ever in our favor with that capital gains tax, at least for the people that, at the lower end of the income in Australia. I think that's the one that we need to get rid of for the people who need it.